Hi everyone, this is Gary Wilson. Welcome to this week's live investor agent webinar, and welcome again, of course, to all of you who've taken the Flipping for Profits program and rental properties without the pain, or the turning rental problems into real estate profits, which of course is the property management program. So welcome aboard to all of you. Also welcome aboard to all the new folks from Tucson, Albuquerque, Lubbock, Midland, Abilene, and all around Dallas. You guys are the newest folks there, so welcome aboard. A little bit of administration here. You'll see on your panel you have the ability to post questions. I get to see those as they come in, and normally that's how I take on your questions and answer them. From time to time, I will unmute you, okay, and bring you live on audio, which means this is live and unscripted, so everything you say, everybody hears. Which is one of the beauties of this, because you get to see and hear all the good, the bad, and the ugly, okay, which is very educational. So in any case, for the new folks, I just want you to make sure you're aware that as far as my schedule goes coming up here, tomorrow I'm wrapping things up in Vegas. I'm not teaching. I'm actually going to a place called the Valley of Fire, which is one of the top 100 natural wonders of the world outside of Vegas, rock formations with all kinds of colors and cool stuff like that. And I'll be in Dana Point this weekend, hopefully riding some waves, whale watching, and taking a ferry out to Catalina Island. And the next week I'll be in LA teaching. The week after that, I have my own mastermind group down in Florida, so I'll be over there. The week after that is when I'll be up in New York and northern New Jersey. So look for me up there that week. I know some of you want to get together with me, like Natasha, and I appreciate that. I love the in-person one-on-ones. And then that Saturday the 11th is when I'm teaching the Manhattan RIA group. So I want you guys to pay attention to this. This is getting to be kind of a hot item here. I'm teaching at the RIA groups, and I'll come to any area to teach at your RIA group. Usually I just need an introduction. I'll teach the local offices sometime during the week. We'll bring everybody together and do a kind of an open forum class for the agents during the week and the investors one night during the week, and then that Saturday, the following Saturday in your area, I'll stay and do one full day of complete instruction. That's what we're doing here. So Dana, that's quite a hike for you, but you might want to consider coming down to Long Island. I'll put you up. You got a roommate already, so we'll put you in my room, and you can kind of observe the whole thing for the whole day if you're up to it. A little bit of a drive. If not, I'll be up there sometime this summer. We'll do one up there. But in any case, the point is this, guys. The beautiful part is this. All the investors are coming in. They're going to get a full day of instruction alongside you, okay? And a couple of possibilities. Number one is they'll decide to get their license, and perhaps you can add them to your downline, whatever it is your company offers. Or they decide they're just going to work with you because you know what the heck you're doing. All right. So definitely, pay attention and participate, and let's help you guys get set up in your areas. That's on the 9th. Now after that, I come back to California for I think a total of 1, 2, 3, 4, 5 weeks. Then I come back to Vegas for a week. That's the week of April 17th, and then following week I'll be down in Phoenix in another conference. So in any case, that's my schedule out in the near future. By the way, for the Californians, the week of the 13th and the week of the 20th, I will be in the LA area. That's March. The week of the 27th, I'll be in the San Diego area. The week after that, I'll be up in the Palm Springs area, Big Bear area, that kind of thing. And then the week after that, the week of April 10th, I will be up in Central Valley, Bakersfield, Fresno, and off over to the coast, San Luis Obispo, and a couple areas out there. So if you're in the LA area, you want to meet up with me, please let me know. Okay, I know one of you already has told me that, and I look forward to that. So anyway, sorry it takes so long to explain. I just want to give you where I'm going to be and give you the lay of the land as far as what's coming down the road for opportunities to increase your business and get investors directly in front of you. It won't be a better opportunity than this. And get a full day of education out of it too. Also next week, I believe it is, I think it's next Wednesday the 22nd, we are going to finally roll out the wholesaling program So far, over 70 of you have signed up. So if you haven't signed up, go ahead and do it quickly, guys, because there's only 100 spots. And it's basically, first come, first serve to be live, so you can actually engage and interact. Otherwise, you'll have to get the recording. But I want you there live as much as possible because it's kind of sensitive subject. A lot of people find themselves not understanding it fully, and it creates problems. And we want to prevent that. Number one, we want to keep you out of risk, and number two, we want to keep you in profit. So there absolutely is a way for you to either wholesale yourself as a licensee and or work with investors who are wholesalers legally, correctly, ethically, and also, of course, profitably. Just hang on to your hats because you're going to learn some things that are be some real eye openers. That's next Wednesday. Okay, guys. Let me see. I got another question here. This is David. Hey, Gary. Hope you're well. Let's see. David Evans. Whoops. Sorry. My panel is just going crazy here. David, let me get back there real quick. Hang on one second. Where was I? Here it is. Okay. I see buying rentals on your screen. Yes. So you guys should be seeing the screen that says buying rentals. So Dana, give me a buzz tomorrow. I'll be driving from Vegas down to Dana Point, the beach aptly named after you, and we can talk about Manhattan. So, okay. Let's see. Herminia says, I spoke with radio station hosts. They're willing to meet 4 p.m., 6 p.m. on the 6th or 7th. Excellent. Okay, so Herminia, you and I need to talk. We need to do another one-on-one, okay? You're going to send me emails. Wonderful. Okay. How do I sign up for the wholesale class? Teresa, look. You should be getting emails from Beverly. They might look like they're coming from me, but Beverly's sending them with the link to sign up for the wholesale class. So look for that. If you don't see it, just email Beverly. Okay, guys, so we better hop into our subject here. We're burning clock time. All right, what you're seeing on your screen is buying rentals. Now, what I did, guys, is I'm into Module 2 on the Investor Agent training program. This also is very similar to what you'll see in the Rental Problems Without the Pain training program, formatted differently and structured differently because, obviously, the different audience. However, the material is similar. In here, it's a little bit summarized. If you want the full set of material, you'll have to get the Rental Problems Without the Pain program. We just want you to focus on one at a time. So I don't want you to, please don't jump around and start getting into different programs unless you're comfortable and ready. When you're ready, you just let us know and we'll get you in. But for right now, let's focus on this within the context of working with landlords, okay? All right, fundamentally, two basic ways to acquire rental properties. One of them is to purchase turnkey properties, which are properties that are already up and running. They're already rented. They're showing cash flow. You've got history of profit and loss, okay, and they typically do not have deferred maintenance, or I should say substantial deferred maintenance, all right? Which leads me to the next option. You can buy wholesale. I don't mean wholesaling in the way of investing wholesaling, but buy well below retail value is what I mean by that, okay? Typically, those properties do have deferred maintenance, so therefore you have to remodel them, okay? Now, you can either sell them for profit just like you flip a single-family home, or you could rent and refinance, okay? So what we mean by that is, let me give an example here. It's a little bit it's on subject, but not necessarily in your material, okay? First things first is this. You can flip rental properties just like you can flip single-family homes. So I want you guys to just please write some notes here, because this is an excellent strategy for your clients, and particularly if you're in areas where there's you're having a hard time finding inventory for flipping. Typical single-family homes for flipping, that is. All right. So let's say your client can acquire a 4-unit building. They have the funds. You show that you find them the inventory, you give them the tools to analyze the inventory, and they buy this 4-unit building that has deferred maintenance. Okay, they can dramatically improve the value of that building in two ways. Number one is by remodeling the property and in raising the value in a physical sense. In other words, the physical nature of the property is now greater and more valuable than the physical nature of the property before they remodel it. So there's deferred maintenance. Maybe the units need new carpeting, painting, the obvious stuff. We call that lipstick and rouge. Lipstick is the, well, you got it figured out. In any case, but perhaps they need more. Maybe they need new countertops. Maybe they need new cabinetry and countertops. Maybe they need new windows, new doors, new lighting fixtures, what have you. The bottom line is, let's say you have a 4-unit building. Throughout a year, and most lease terms are annual, by the way, in most cases, throughout the year, all 4 leases will come due. So what really good, smart, successful flippers do is they'll look for these multi-unit buildings. As each lease comes due, they will notify the tenant 60 days in advance. In most cases, sometimes it's 30. Okay, a lot of states are 60 days. They're not going to renew the lease. Now, if you're in New Jersey, bear in mind that the law in New Jersey is a little bit weird. What they say is you just can't unilaterally tell somebody you're not going to renew the lease. We're not talking about evictions here. We're just talking about a simple lease renewal. In most states, you can just say, hey, 60 days, your lease is up, or we're not going to renew it, and tell them why you're going to remodel. So the rule in New Jersey is this, the law in New Jersey is this. You have to, it can't be unilateral. Both parties have to agree to not renew the lease term. The only exception is if you're going to perform work on the property, okay, to bring it up to code, for example, to bring it to current standards, that is legitimate. Okay, a lot of people misunderstand it. They think they have to have the tenant agree. That's not necessarily true. If you're just simply not going to renew them for no good reason, you might have a little bit of a challenge on your hands if the tenant decides to, basically fight you on that. But if you tell them, hey, look, this place hasn't been remodeled for a while, we're going to get and remodel it, make sure everything's up to code and all the safety standards are met. That's a legitimate reason. Okay, regardless of that, let's just say you get past that. You remodel the unit, so now the unit is more valuable in the physical sense. Okay, new cabinetry and so forth. Also, you raised the rents. Obviously, you're not going to just rent that for the same amount that you rented it for before the remodeling. So in any case, long story short is this. Throughout the year, you can go through all 4 units, remodel all 4 units, raise all the rents on all 4 units, and increase the financial worth of the building throughout a year. Now, if you're wondering, if you have some question marks for why would anybody do that? A couple reasons. Compared to a single-family home, when you flip a single-family home, that property's bleeding red profusely while you're remodeling it, and it's empty. It's not bringing in any income at all. It's just sitting there. All the money is going out. When you own a multi-unit building, like the fourplex in this example, okay, even though you take 1 unit out of service for a while, you still have 3 other units in service bringing in income, bringing in rents. And in fact, in a 4-unit building, 3 of the rents are probably covering all your costs, all your overhead, all your expenses. So your property is actually making money while you own it and remodel it. So at the end of the year, you weren't just out all that money. Okay, you had money coming in covering your costs. You sell it for profit because now it's more valuable financially and physically, okay, or you could just keep it. So in any case, I just want to point that out. Let's say we've got through that example now, and we have an owner who decides, you know what, I'm going to go ahead and keep this one. In that case, you'll of course make sure everything's rented out, and then you go and refinance the property, and the new value, of course, is going to be much higher than the old value. So let's say, for example, you bought a property, a 4-unit building, for $400,000, okay, and you put $100,000 into it, and it makes the property worth $600,000 because you create value in remodeling. It's not just a dollar for dollar ratio. You actually create $200,000 in value by spending $100,000 on improvements. Okay, so now the building's worth $600,000. You can go to a bank and refinance that. And let's say you refinance it at 80% loan to value. What would that be? That would be 600,000. 80,000 times 5 is 400,000. That doesn't make sense. That number. In any case, you get what I'm saying here. You could refinance that 80,000 times 6. I'm sorry. That would be $480,000 in a loan. So now you've put 400,000 into it, purchase. You put 100,000 into remodeling. You refinance it at a value of, based on a value of 600,000, and you do an 80% loan to value loan that allows you to take a loan of $480,000. Okay, that means you recuperate your original cost plus 80% of your remodeling costs, which means you only have $20,000 in the property. Okay, and for $20,000, you essentially picked up another $100,000 in equity. That's a huge return. It's all on paper at this point, but it's nonetheless a legitimate return. And you've increased the rents, so now you're bringing in much more cash flow. All right, so essentially you spent $20,000, and maybe you're bringing in, $8,000 or $10,000 a month in rent, and those numbers are legitimate numbers for New York, for example. Okay, so you see the value of that approach. Very good approach. Now here's some reality checks. Right? Let's. I'm going to reduce my panel for just a second here, guys, and I'm not going to see your questions for a minute, but I have some further explanation for you. All right. Good news and bad news. Good news is this: in a declining market, it's easier to do that second approach. It's easier to buy low, remodel, refinance at a higher value because there's more inventory. Banks are they're interested in making loans. Okay, they want to get back into the game of making money for making loans. In a tight inventory market, however, it's more difficult to do that. In a tight inventory market where you're essentially coming out of a down market, in other words, your market's now coming back up. Okay, you typically have tighter. You've all experienced it these last few years. All right, price escalations. The lenders have been through a recession. They're not very excited about taking on debt on properties that they've already foreclosed on. Okay, so in that case, you would want to buy what we call turnkey properties. That's the other approach. So turnkey is these properties are already up and running. They're showing a profit. They're basically in good repair. And you've got to come up with your down payment of 20%. The bank will finance the other 80%. Okay, and you cash flow when you have equity in the property. Not as glamorous as the other approach, but it's also not as time consuming. And the other thing too, guys, is this. The day you close on a property, let's just use the 4-unit as an example again, except this time it's turnkey. It's completely occupied. You literally are making money, all of your profit. You're profiting fully 100%. In other words, all your units are rented from day one. Okay? So if you think about it, you purchase a property, you go to a bank for a loan. Do you think the bank would be more excited about financing a property that's fully rented up and running with no deferred maintenance, or would they be more excited about financing a property that has a lot of deferred maintenance and maybe has a vacancy or two? Well, it's the former. Obviously, banks, especially in a recovering market with tight inventory, they want to make those kind of loans. They're not too interested in making loans on properties that have vacancies and a lot of deferred maintenance. Okay. That strategy is better for a declining market. So just keep in mind the two approaches have their place in different markets. In any case, I just wanted to give you that broad brushstroke of the two basic approaches of acquiring rentals. I'm going to go into an example here, but before I do, let me slide the panel over and look for questions. So hang on one second, guys. Let's see. I think. Hey, it looks like we're caught up. Yeah, we're caught. Okay, so no questions so far. By the way, just give me a shout out, guys. Is everybody okay with what I described so far? Hopefully I took enough time to describe that. If you could just give me a thumbs up or a yes or a no. If you have more questions, if you need an explanation for that, please let me know, because those two strategies, you need to understand those when you're working with investors. You need to be able to guide them, consult them, and advise them depending on what your market's doing. Okay, all right, so far everybody's okay. Well, let's take a really old example, but a really easy example. If you notice, this pricing here is old, but remember, guys, it doesn't matter where you are, what type of economy we're in. The fundamentals never change. Only circumstances change, but the fundamentals don't change. So everything I'm going to teach you here applies today just like it applied 80 years ago, and it will apply 80 years from now. All right, this is an example of a property I actually used to own myself years back. Bought it, kept it for a while, fixed it up, raised the rents, and sold it for profit. So let's take a look at this, and we'll see how we do a real basic cash flow analysis on this property. And depending on time, I'll go into 2 other advanced methods to do cash flow analysis. And hopefully some of you guys brought examples too. So if you have examples of rentals you want to bring up on the opportunity evaluator, which we'll do next, just share them with me. Give me the numbers and we'll plug them in. But for right now, let's use this as our foundation to learn the principle, and then we'll go into the more advanced stuff here in a second. So first things first. This is property I initially purchased way back in the day when I didn't have gray hair for $20,000, excuse me, and I put $15,000 into it. Okay, this is when I was able to pay guys, you know, $10-12 an hour. So what I did was the building, upon a bank's appraisal, turns out it was worth $65,000. So right away I was well ahead of the game. You know, I had $35,000 into it, and now I had $30,000 in equity. So I went to the bank, and the bank that I did the appraisal, I said, okay, I don't want to borrow 80% of that. I just want to borrow 75% of it. And so I borrowed $45,000, which is 75% of $60,000, a little bit less than 75%. But what that allowed me to do is pay myself back completely, the $35,000, you know, the $20,000 purchase plus the $15,000 remodeling, and also put an extra $10,000 in my pocket. All right, so I basically increased my capital, available capital to use to invest. I also kept equity in the property to the tune of $20,000, right? And more importantly, I had positive cash flow, right? So let's take a look at this. $65,000 property. I eventually did sell it for $70,000. I think I listed it for like $79,000, and I sold it to one of my students actually. So I gave him a $10,000 discount, and he got it for $70,000. So in any case, I had the mortgage paid down by that time to $35,000. I'd paid $10,000 off the mortgage. So essentially, I got $35,000 back at the closing. Now just think about this, guys. I initially got $10,000 back after I refinanced it early on. You know, I'd bought it, remodeled it, refinanced it. Got $10,000 over and above my initial cost there. I sold it, got another $35,000. Okay, after I paid the mortgage off, I kept $35,000. That means I got a total of $45,000 net gain on a capital gain side of the house. All right, and the reality is I actually owned and had the thing rented out the whole time I owned it. So let's look at that part. We're gonna look at that now. All right, the thing was bringing in $11.50 a month in gross rents. I had a 1-bedroom, a 3-bedroom, and a garage. You can see the numbers there: $450 plus $625 is $1,100. Is that right? $1,075. Then a $75 garage per month. That's $1,150. There it is, right there, $1,150, for a total of $13,800 per year. So go ahead and write this down. I want you to mimic this as I go through it. All right, that's your cash flow. Monthly cash flow, add all these up, is $1,175 times 12 is $13,800. That's your gross receipts for the year. All right, now here's some of my expenses. And if you're in the New York area, or if you're up in Toronto, or you're out in any of the really big, highly populated areas, LA, you're looking at that tax thing, you're thinking, holy crap, where did you live to pay that low tax? It was just the times. In any case, that was the taxes, about $700 a year. Insurance was $322 a year. And by the way, if you ever have a question on insurance, let's just do a different class on that. There's different strategies you can use to keep your insurance costs down. In any case, taxes, insurance, water, which included garbage and sewage, was about $1,400 for the year, a little bit less than that. Maintenance and repairs was always averaging about $50 per month, okay, on a property like that, because it really wasn't much to do. I mean, the tenants cut the grass and shovel the snow, clean out the hallway. You know, this was just things like, you know, for replacing a bad light fixture, whatever, replacing a doorknob. But it just, you know, it doesn't take much to gobble up $50. So in any case, net operating income then, when you subtract these figures here on a monthly basis, you divide all these by 12, subtract that from your monthly cash flow, which is $1150, you end up with about $900 a month in cash flow, $899.46 to be exact. Annualized, that's $10,793.54. So in other words, I could either calculate everything on a monthly basis and annualize it by multiplying by 12, or I could simply calculate everything on an annual basis. In this case, I would have taken 13,800 and subtracted these four figures, and I'll be left with this figure right here. Okay, that's my annual net operating income. Now, so far we have not accounted for any debt service. That's coming up next. For purchase price, $70,000. All right. Down payment 20%, $14,000. That leaves a loan balance of $56,000. In other words, we're getting a loan for $56,000, or this buyer was, combined with his $14,000 down payment, and he was able to purchase that $70,000 property. Now, I always instruct my students to get 20-year loans. I want you to do 15 eventually, but I want you to get weaned off the 30-year loans as quickly as possible. And it's easier to go to 20 years than to go to 15 years right out of the gate. Interest rate a little high by today's standards, but nonetheless, that's what it was at the time. So 20 years at 5% on a $50,000 loan, turns out the debt service, in other words, principal and interest only, was $369.58. Okay. Now, if you remember, our monthly cash flow after known expenses, after taxes, insurance, water, maintenance, our monthly net cash flow is $899.46. So we take that figure and reduce it by the amount of the loan. Again, this is just principal and interest. Remember, taxes and insurance are already accounted for. Those are expenses. All right, they're not coming out of. You've already accounted for them in your loan payment. Or your monthly expenses, excuse me. So in any case, what I'm getting at is $899.46 minus $369.58 monthly principal and interest. Turns out it's $529.88. So that's your actual cash in pocket return after all expenses and reducing it further by principal and interest on the loan. Not too shabby. $529.88. I'll take that every day of the week. Okay. Annualized, it ends up being $6,358.56. In other words, $529.88 net operating income minus debt service times 12 equals $6,358.56. Okay. Now, here's where we get our ratios, and I'm not a big fan of ratios. They are important. Investors rely on them. We have to rely on them. I'm always looking for what I consider cash in my pocket. How much money how much is coming out and how much is coming in, which leads me to the first ratio, which is called your cash on cash return. All right, different than cap rate. We'll go over that next. Okay, but cash on cash return is this: you take your actual cash in your pocket, okay, on an annual basis. In this case, $6,358.56. And you divide it by your cash outlay, which in this case is a down payment of $14,000. So in other words, 6358.56, excuse me, divided by 14,000 gives you a ratio of 45%. That means the $14,000 that came out of my pocket is giving me a 45% return, and that 45% return shows up right here, $6,358.58. You can just do simple math there and tell that this 6358.56 is just less than half of 14,000. Half of 14,000 is $7,000. So if that was 7,000, the cash on cash return would have been 50%. But nonetheless, I just want to give you an idea of how this is calculated. You take your actual your cash out of pocket cost at time of purchase, okay? Cash outlay. You divide that into your cash in pocket return, and that gives you your cash on cash return. All right, let me just let you digest that for a second, and then we will get into the cap rate, which is not that much different, but it is different. So hang on one second. Okay, cap rate. Cap rate is determined by taking your net operating income before debt service. So in other words, you're taking your gross receipts, $13,800 for the year, subtract all non-debt related expenses, taxes, insurance, water, maintenance, and repairs. You're earning $10,000, $793.54 per year. Out of that, you got to pay for debt. Okay, so right now, we're just calculating cap rate, which does not account for debt. So what you do is you take this net annual return before debt service and divide that by the total price of the property. So in other words, cash on cash return is taking your cash in pocket divided by cash out of pocket. Your cap rate is determined by taking your net operating income before debt service, divide that by your total purchase price. Remember, total purchase price is not the same as down payment, obviously, right? So $10,793.54 divided by 70,000 gives you a 15.4% return. So that's what this guy got when he bought my property. He was purchasing at 15.4% cap rate. All right. So, in any case, I wanted you guys to think about that for a second. The two different ratios, how they're calculated, and more importantly, why they're valuable. See, a lot of newer investors focus on cap rate. Seasoned investors are interested in cap rate, but they migrate towards and focus more on cash return, because that's actual dollars. And I'm the same way. You know, I'm flattered by a 15.4% cap rate. What I want to know is, what does that translate to in terms of actual dollars? And I use the cash on cash return to help me figure that out. So let me do a quick pause here, guys, and bring over the panel and check and see if we have questions. Let's see here. Hang on one second. We do have a couple. Let's see. I got to go back here. Let's see. Yes, Maria. So Dana says, I never understood the cash on cash return until now. Good, Dana. So that, yeah, so hopefully that explanation helps you. What I would do, guys, is I would practice these. Just take some sample properties from your transaction history, or just go online on your MLS and look for sold properties. A lot of times you'll get an attachment that'll give you the pro forma or the last 3 years returns on those properties. You can download them and practice using this. You definitely want to practice this because you want this to be second nature, right? And this doesn't take that long to learn. This is the basic stuff. But then you can walk the talk, you know, with your investors. Okay, so Peter says, okay, what is value of knowing cash on cash return value? So Peter, one thing is this: investors who invest in other commodities, like, you know, tobacco, pork bellies, or they invest in stocks. Okay, if you think about it, while you can certainly use a margin account to purchase stocks and commodities, often investors in those markets don't do that. They're just simply investing. So they invest $1,000, they get $1,000 worth of ownership in pork bellies, for example. But essentially, what in the return they get is cash on cash return. In other words, they put $1,000 in, they get, you know, $5,000 a year return. It's a 5% return. That's actually a cash on cash return. So the reason why cash on cash return is so important is investors will look at this and determine, is this better than me purchasing pork bellies or tobacco or what have you, you know, or petroleum, for example. All right. Of course, I think the answer is yes. The other thing too is, if you talk to seasoned investors, like, you know, many of you know I got to meet Robert Kiyosaki. He told me early on, he said, Gary, you know what? Seasoned investors, successful investors, over time migrate from focusing only on cap rate to looking more towards the cash on cash return, because that's really what reflects your actual return on investment in actual dollars. In other words, dollars in, 14,000, dollars out, 63.58.56. Am I satisfied with that return, in which in this case is 45%? You better believe I am. Matter of fact, I look on anything that has a cash on cash return of 20% or greater. All right. Cap rate, I mean, I can go down as low as 5% depending on where we are in the country. Everybody wants a 10% cap rate, but that's just not realistic. I mean, this is realistic in like Dayton, Ohio, for example. Okay, Macon, Georgia, parts of Texas. You'll get those cap rates all day long. Michigan, Ohio, Indiana, Illinois, you know. So in any case, so Peter, I hope that answers your question. It's just, you know, it's if you do these examples and practice on your own and ask yourself if that was your money, which return is going to appeal to you or be more meaningful to you? And investors eventually get to the point where it's a cash-on-cash return. So excellent question, by the way. Let's see, Dana, roger that. You got it. Lewiston, Maine, yeah. Lewiston, Dana. Matter of fact, I think that's where one of the girls lived that I met down here in Vegas. She was in Lewiston. So, in any case, Peter, yes, you answered my question? Okay, you're very welcome, Peter. All right, guys, let's do this. It's 18 till, and let's at least get to one of the advanced calculators. So real quick, if you guys could give me a shout out, let me know that you're good to go. You're comfortable with the basic cash flow formula. We'll move to the Excel spreadsheet, which is a little bit more advanced. If you have examples, please let me know. I'll be glad to put your examples up on the board here. Let's just go to the calculator, actually. Okay, so I'm going to have to reduce my panel here for a second, guys. I'm going to go up top, and I'll put in some, we'll just start with an example. We'll just do that. And then you guys can post questions all day long. All right. And here's the example that we just talked about. And by the way, this is purely dumb luck, because I had no idea that this version of this spreadsheet was already filled in with all these appropriate numbers. I just got lucky, I guess. Every now and then, even a blind squirrel gets in that, right? So, in any case, first things first. Everywhere you see the plus sign, as my cursor moves, that's an editable field. So you can see 70,000 is an editable field. In this case, it's the purchase price of the property. It's the first thing we fill in. Okay. And by the way, just to alleviate some of you might have a little anxiety here. This Excel spreadsheet, all the math is done for you. All you got to do is plug in your numbers. So all the calculations are done for us. We don't have to do a thing. So 70,000 is the purchase price. All right. We've plugged it in. You don't have to fill this in here. Generally, if you actually come down here to this kind of a beige area, you can put in your loan information here. In this case, we have a loan of $56,000. Okay. We're going to assume 12 payments per year. We're also going to assume a 5% interest rate. So these are fields you have to plug in. We're going to assume a 20-year mortgage, which gives you in other words, 240 payments. And we're going to make the term match the amortization period. Then what that means, guys, is this. Your loan term can be different than your amortization period. So, in other words, I could have a loan being amortized for 20 years, but I could have a term of 10 years, which makes this basically, there will be a balloon payment due at the end of 10 years. Because obviously, if you're amortizing for 20 years, at the end of 10 years, you still are going to have some outstanding principal that needs to be paid off. So in this case, we're going to assume the term matches the amortization period. All right. So you plug in those values. All right. Amortization period, interest rate, number of payments per year. $56,000 means our monthly payment is $369.58. So what happens is when you plug this in, this field automatically gets populated, and vice versa. You can see that both has a plus sign. That has a plus sign. Now I'm going to assume just for the sake of this exercise, there's no loan points. Okay, when interest rates are very low, I'm sure not going to pay points. And if a bank wants to impose it on me, I'll just go somewhere else. And also, your down payment or initial investment is automatically calculated by subtracting the loan amount from the purchase price. In other words, 70,000 minus 56,000 leaves a down payment of 14,000. Okay, so far so good. By the way, this same property would be twice this right now, right? So in any case, let's go down here. So this is the purchase information, and this is the loan information. Purchase information here, loan information here. Now let's go down into the rents, okay? So I'm going to drop my screen down just a wee little bit here. All right, we know we have one unit, a one-bedroom unit, one bedroom, one bath. We have one of those renting for $450 a month. And it automatically calculates the annual gross receipts for you. So $450 times 12 is $5,400, okay? We also had a 3-bedroom, 1-bathroom unit that we were renting for $625, and that unit annualized yields $7,500 per month. Okay, and of course, then we had that little garage rented for $75 a month. Annualized brings us $900 on an annual basis. In other words, 75 times 12 equals 900 bucks. Add all those up, we get $13,800 gross receipts per year. All right, so we're good to go there. Let's drop down. And we're going to take that figure, by the way. This is going to be populated over here. All right, that 13.8 on your gross receipts on an annual basis gets plopped into here, which is a gross potential rental income. Okay, all right, let's drop down here and let's see what we're going to do with these numbers. First thing is I'm realistic. I know that over time I will have some vacancies. People move out, it takes time to repaint and things like that. The average vacancy rate excuse me, will vary in different economies. Excuse me. So in an economy where, like in the last few years prior to the last recession, if you think about it, people were getting loans that had no business getting loans, all right, and that depleted the pool of really good renters, because a lot of those renters are now becoming homeowners. So the average vacancy rate back then could have been, 5, 10%, 12% in some areas. I even saw areas that had up to 30% vacancy rates. Okay, but historically it's around 3%. In fact, the last few years it's been more like less than 3%, 2% in some areas. I've had periods in my investor history where I had no vacancy. On a percentage basis, I was fully occupied at greater than 100%. And what I mean by that is I might have people vacate and leave their deposit behind because they didn't do something like cleaning, and I was able to keep the deposit, or they left early and left money on the table, and I was able to rent the place, turn it right around and rent it again. But in any case, on average, let's just say it's 3%. So 3% of 13.8 happens to be $345. By the way, real quick, if you notice over here, your ratios or percentages are calculated for you automatically. In other words, 345 vacancy is 0.22% of gross receipts. All right. We also know what our tenants are paying per square foot. They're paying $8.63 per square foot. So obviously those rents are higher now. The rents are probably more like 10, 12 bucks easily. All right. So in any case, we subtract the vacancy dollar amount from a gross receipts, which leaves us a effective rental income of $13,455. Right. Now that's our gross operating income. All right. That's the money we have to work with to pay expenses, to pay debt service if we have any, and more importantly, to put some money in our pockets. So let's now add in some expenses. Remember, these are all editable fields here. Anything that's highlighted is an editable field. So we got taxes for $600, insurance for $300, management. I actually threw in management on this example. By the way, real quick caveat here, guys. Please just put your pencils down for a second. A lot of investors who buy rental properties will not account for management fees because they're assuming they're going to manage the properties themselves, which they can certainly do. However, if you grow and thrive in this business and you continue to acquire more rentals, you will find yourself using and paying for property management. So what we suggest is account for the cost of management right at the outset. Don't say I'll add it in later when I'm making more money. Okay, it doesn't get any easier. All right, so you want to account for it right out of the gate, because you might, whatever, you get married, get a new job, win the lottery, whatever, get injured maybe, and you don't want to or are unable to manage your property anymore. That's why you account for this right out of the gate. You've at least got the money earmarked to pay for management, and we always assume a 10% management fee. Okay, enough said on that. Moving forward, we don't have any payroll, but we have maintenance and repairs and labor combined to the tune of $600 on an annual basis. So we plug in that should be combined $600. I don't distinguish between the cost of materials and labor when I'm doing that. When I was doing this, bring this back up. If you notice here, maintenance is $600 a year. That accounts for the cost of materials and labor, right? Over here, oops, there it is. It's actually broken apart. Oops, I'm sorry, 300 and 300, okay? In any case, combined $600 maintenance and repairs. And if you pay attention over here, you'll see how much this is costing you per square foot, what the percentage is of your gross receipts, okay? So let's drop down and see what else we got. Of course, we have water for $13.88, remember that. And our gross expenses, total operating expenses, happen to be $4,268 on an annual basis. In other words, we're spending almost a third of our income on the upkeep of the property, maintenance, repairs, expenses, water, sewage, garbage, that type of thing, okay? You need to be realistic here. A lot of people say, well, it's only 10%. I don't believe it. Maybe in a brand spanking new building, maintenance might be 10%, but that I'd be hard pressed to believe that, because you still have the bigger the building, the tenants will do less. They're not going to cut the grass. They're not going to shovel the snow. They're not going to clean the hallways. So you got to pay for all that. All right. So in any case, and plus people still break things in brand new apartments anyways. But back to this, I just want you to pay attention to the percentages, right? So you can see here, property management is about 10% of gross receipts. Water is about 10% of gross receipts, right? So if we come down here, what we're doing is we're going to subtract the 4268, which is the total of our expenses so far before we apply debt service. So 4268 gets subtracted from our gross operating income of 13,455. So 13,455, all right, minus 4268 leaves a return of $9,187 on an annual basis, right? So far so good. But now we got to account for our debt service, annual debt service. This figure is plugged in here by taking this up here, your monthly payment of $369.58, multiplying it by 12, and this Excel spreadsheet plugs it in automatically here. So in any case, your gross receipts minus your expenses leaves you $91.87. Then you subtract your annual debt service of $44.35, which leaves you a balance cash flow of $4,752. Okay, that's $4,800 initially, which is about $400 per month. Okay, which means you're netting $200 per unit per month owning this building, which is exactly what happened, right? So in any case, I just want to give you that explanation there. Hopefully you guys like this calculator, because it is a pretty powerful tool. I've been using it for years. It couldn't make life any easier because you get to play around with it. In other words, all of these figures, obviously these are variables, so you can modify these. You can change them any way you want. So let's say we paid. Let's go back up. Let's say we paid $80,000 on this. Let's see what happens to our returns. Okay. Debt service goes up. Oops, hang on a second. We didn't. We kept the same. We didn't change the loan payment. So let's say now our loan payment is 80,000 times 8 is 64,000. Oop, I gotta go here. Sorry, 64,000. Okay, let's do that. And let's see, it calculates a different monthly payment. Okay, so we go down here and we can see now our debt service is higher, and our net cash flow every month is lower. But the cool news is this. This still gives you 11.5% cap rate. Your debt coverage ratio is 1.813, which is really good, because generally banks, anything in the 1.75 range or higher is usually pretty appealing to banks. Okay. Now, real quick, you probably are wondering what this is over here. This is what we call the what-if box. It's calculated for us. We don't plug anything in there. The what-if assumes a 10% cap rate in a hold period of I think 5 years, if I'm not mistaken. And in 5 years, this building should be able to be sold for $91,870, right? And if you took the reduction in principal on the loan because you've owned it for 5 years, you can see you kept 27,870. In other words, that's 11, that's 20, 63,000 is what you still owed on the note. Okay, you didn't pay that much off of it, so you paid it off and you kept 27,870 yourself. Again, all this is a projection, a what if scenario. That's all it is, right? You can change the cap rate. You can determine if you refinance or not. But regardless, let's go back here to the beginning. Change this back to 70, because that's actually what the thing, what the student sold it for. Whoops. Delete in 7. Okay, 70,000. Loan of 56,000. Okay, but now let's say we really raise the rents. We're going to go 825 here, and come on, computer. I want to go 650 here. So look what happens to the rents. Okay, and the garage. Let's just say the garage is now $100 per month. Okay. And look at what happens. Oops, one more, delete. Oops, let me go back there, sorry. Let's look at what happens to the cash flow. Cash flow, of course, it's increased dramatically, now $18,900 a year. Vacancy inched up a bit, but the cash flow is still pretty solid. All right. Its expenses stay relatively the same. Let's just say taxes are now 900. Let's just say it's 1,000. Whatever, let's do that, 1,000 on an annual basis, okay? Regardless, if you go down here and, maintenance repairs doesn't change much, water doesn't change much, you can see your cap rate goes up dramatically. Look at the debt coverage ratio. Pretty substantial. I mean, any banker would lend money on this property, hands down, with that kind of cash flow. All right, and you can see the 10% cap rate, if you held it for those period of years, the value goes up dramatically. So what I'm getting at, guys, is this is a tremendous what-if tool, and not only that, you get to see a projection of what might happen in the future. All right, there's lots of things you can do this. Let me do this. Let me bring your panel back over because I've been going for a while. I want to check for questions. So let me go back here and make sure I've cleared them all off. Okay, so this is David Evans. Hey, David. So David's asking, okay, is there any way to measure the hassle factor that goes into managing a place in a location with properties that typically have the higher cap rates? Well, actually, David, the interesting thing is the answer to your question is actually in the cap rate. Cap rate actually gives you it's not just your return on investment. Cap rate represents reward and risk. So typically, the higher the cap rate, the higher the potential return, but also the higher the risks. There's all kinds of risks. In other words, let's give an example. Let's say you buy a property in a really low price area, cap rate's 15%. You might be excited because you're thinking, my gosh, I'm going to make 15% return on my money, which means in a little bit, if you did that in the stock market and you kept all your money rolling back into that investment, after 5 years you should double your money. All right, we call it the rule of 72. But the thing with real estate is that cap rate represents risk. So the higher the cap rate, the higher the risk. That means more headaches, more evictions, people not paying the rent, people leaving and leaving all their stuff there. That's the headache factor. That's part of the cap rate. So just know that typically, the higher the cap rate, the more headaches you're going to have. Right? In fact, there are property management companies who will refuse to serve certain properties in certain areas. They'll look at the numbers. They're going to have you got to come in and show your property, show the performance, show the history. They'll do what you drive by, and a lot of times, by the way, they'll look at the property on an evening during the week. They'll look at it on a Saturday morning, when people should be out playing ball and cutting grass and stuff like that. And more importantly, they'll come out again either very late Friday night or very late Saturday night to determine what's happening in that neighborhood at that hour. Okay, so it's an old trick. I used to do it too. If I was going to take on a bunch of properties for a client, I would go check them out at different days of the week, different times of day, and see what was happening around those areas. And if I didn't feel safe myself, I surely was not going to send my employees there. So I would tell them, I'm sorry, I'm not going to manage that property. There's no discrimination. You're not in trouble for anything. You're just simply using your judgment to determine that you're not going to manage that property, right? So, in any case, excellent question, because there absolutely is a hassle factor when it comes to owning rentals. Now, the cool thing is this: um, when you go into the better areas, all right, and you're buying the more expensive properties, typically they will have lower cap rates in the beginning. But cap rate is not a fixed ratio; it's not static. So on the lower end properties, cap rate only looks like a static because it doesn't change much over time. However, on the better properties, guys, the cap rate actually does go up over time because the rent increases are like compounding, like interest on a CD. The valuation increases. They go up dramatically because the properties are worth more money. So in any case, as a result of the rents going up and most costs being relatively fixed, and also less trouble, less headaches, the cap rate can be improved dramatically over time. And that's why a lot of the really successful investors will only buy the better properties, even though they know they might take it into shorts initially on returns. They know over time the returns will increase more and more and more over time and far surpass all those low-grade properties, right? And I can tell you I experienced that myself. I had older properties that were lower grade, and they just never hardly went up in value. The rents hardly ever increased. But the better properties, all brick, Traco windows, off-street parking, nice landscaping, usually strategically placed around hospital and university systems, you better believe those rents actually went up much more over time, sometimes dramatically. And so the values of those buildings also went up naturally. So in any case, that is an excellent question. And you guys need to be aware of that, because you might find yourself one day being asked to manage these properties. Okay, so Fossil, hey Fossil, how you doing, buddy? Ask, what is a good cap rate in northern New Jersey? So Fossil, I don't know off the top of my head. However, I can tell you how to find out. If you have a commercial guy in your office, they have all that data available to them online. They usually are members of CoStar or LoopNet. And I know your Keller Williams, there's actually if you have a commercial guy in your office, just ask them. There's a new tool coming out that gives you all kinds of really neat information. It's free for the agents. But in any case, you can also do this. Look at some sold properties in your area, sold multi-units, okay? Go to the listing, because almost always will give you the cap rate, and see what the prevailing cap rates are, okay? Now, I would double check a few of them just to make sure the other agent knew what the heck they were doing. But you can usually it'll give you in an attachment, if not on the listing itself, the numbers on the property, the income and expense, so you can determine cap rate for the area. I would just give you a guesstimate, Fossil, based on me being up there last summer, and I was there in July and August and September. Your cap rates might be somewhere around 5 or 6%. Okay, and by the way, in New York, in the city, they're even lower than that. Out heck in California, people are purchasing properties in the Bay Area, for example, with negative cash flow. All right, negative cash flow, but they know those properties are appreciating dramatically over time, so they'll have a more valuable property in a shorter time frame. In other words, their game is capital appreciation and less cash flow. More capital appreciation, less cash flow. That's their game. In areas that are really low priced, generally cash flow is the game. You're not going to get great valuation increases, but cash flows, let's face it, cash is where it's at, right? So up northern New Jersey, Fossil, you got Montclair, Clifton, all these different areas, Tenafly, Hoboken. It varies from area to area. So you want to get examples of properties from your area. You can also Google cap rate for your particular area, and you'll get a couple different online resources providing you what those cap rates are based on historical data. So anyways, hope that helps, man. That was a good question. Okay, guys, that was pretty much what I wanted to show you tonight. There is another calculator I'll show you next week. It's an online calculator, but for tonight, that's probably a lot for one session. I don't want to overwhelm you. But if you have examples, please bring them next week, and we will go over them. And next week, by the way, let me get my book and tell you when that is. So next week is going to be on the 22nd. Actually, no, 23rd. I'm sorry. So the 22nd is the wholesaling webinar presentation. The 23rd is our weekly live webinar. So that's next Wednesday, 4 p.m. California, 7 p.m. Eastern. And we'll go over the rental property reporter, which is the online calculator, and we'll bring up some more examples, and we'll see where we go from there. After that, I'll start to talk about flipping for a while. So in any case, I appreciate you guys being on here. As usual, it's fun seeing you. I've got to see some of you at Family Reunion. That was pretty awesome. And I'm going back into areas where I've been before. So I want to meet with you guys. If I'm coming to your area, please let me know in advance, because I'd love to hook up with you. Hey guys, hang on. We got one more question here. This is from Maria Banks, and she is asking, okay, this is awesome. Lost out on an opportunity last week, a triplex for 138. Not sure what it ended up selling for. We will find out later, Maria, once it gets posted online. Once the sale occurs, it's public information. We'll be on the lookout. Oh, well, good for you, Maria. Hey, Maria, if you're ever stuck on something, just shoot me the pro forma. Just send me an email, and we'll bring it up. We'll bring it up online and look at it online and slice it and dice it and do some what if scenarios. Okay, this is Dana. Call you tomorrow, bro. You got it, Dana. All right, guys. Hope you have an awesome night and an awesome weekend. God bless you all and your families, and I will see you next week. Okay, bye-bye.